and welcome. My name is Joseph Vecchio, founder of Shore Financial Planning, and I'm excited to speak with you today about hiring children in your business, a tax planning strategy called income shifting, where we legally avoid taxes by strategically planning ahead, involving our children into the business, giving them life skills, and we're able to shift our income for successful business owners. That whether you're there or not, this strategy is for business owners that are generating money and at their marginal tax rate. That's how we calculate savings, at marginal tax rate. You're entitled to shift your income based upon standard deductions. What a standard deduction is each child is entitled to a standard deduction for 2023. That number is $13,850 per child. So, to keep things rather simple, a simple person, I like to keep things simple, $13,850 per child. In my case, I have 3 children. I multiply that $13,850 times 3. It's $41,550 times, the effective marginal tax rate at 35% is a tax savings of $14,542 in your pocket. Now, if you have another child, that'll go up, go down. But this is gives you an idea of how to shift income. How we shift income, we take it and we push it from that 35. We shift income, and we shift income from a high tax bracket of 35%. Right down and collapse it down to 0%. That's zero tax advisory. That's how it's done. One strategy. This is a great strategy. Now it depends upon how your company is structured, is how this will ultimately take effect. So I kind of broke this down into 2 ways. So if we're a single member LLC, sole proprietor, so you're filing your returns on, or a parent partnership. So it might be on a 1065, it might be on a, strike that. So now it's about the taxation, so hiring children, this strategy, how it will impact you is ultimately depends upon how you're structured. So if you're a single member LLC, which is a sole proprietor, a parent partnership too, basically, the IRS perceives you as the parent and no payroll taxes. This is great. This is ideal. So there's no payroll taxes, right? So the business gets a deduction. We get income tax-free. That is a great win. Now, in the event, if you're structured as an S Corp or a C Corp, now the business will have to pay its share of its payroll expenses, 7.65%, and the child will have to pay 7.65%. Now, this is not ideal. This isn't the only way, and there is another option if you're set up this way, because an S Corp makes a lot of sense for many businesses, and just because there's another option. Now, caveat emptor, in order to do this, we have a tax plan, and just because we watch this reel doesn't make it a strategy. Consult with your tax advisor to do this, because this increases the level of complexity now. If we have that S Corp, which is many times a great way to structure a business, but if it flows through here and we're shifting income to children, it's possible we might need to form a family management company, which is then just a sole proprietor that basically then pays the children to avoid payroll taxes. And that's what this is about, avoidance. Tax avoidance is legal. Tax evasion is illegal. Let's just follow the steps, implement them, properly document them, because then we come to the next part of the process in to do. How do you make this in terms of taking the tax plan to take the estimated tax savings and then turn that into realized tax savings? We create our plan and now we need to implement them. So we got to do these two to-do steps, right? So for our children, we need to determine reasonable compensation. So reasonable compensation, we start with minimum wage. We can't just throw this number. We have to document it. We have to create separate bank accounts, timesheets. We have to make the children sign their timesheets. The business will pay the child directly in that bank account, and it must be paid on a regular frequency account. So there is a level of compliance here, right? So as I said, caveat emptor, tax savings are great, but to have a plan and implement it, you got to start with the plan, implementing it throughout the year, making sure it's done. So if there is ever the chance of an audit, which is okay, you need a legally defensible position. And by tax planning and implementing it in the right way, as I discussed here, which you could do on your own, or consult with your tax advisor, it might be done. So if you want to know the to-do list, there's a PDF link below. Click it below, and I'm happy to share that with you in terms of how to actually take this and put it into action. I hope you learned a lot. Listen, tax planning offers a lot of valuable ways to permanently reduce your taxes, and this is just one strategy of many. So stay tuned until next week when I release my next video on how to plan and reduce your taxes. And if you choose to do so yourself, I suggest you just at least consult with a tax advisor to make sure you're doing it properly. Until next time, stay well, my friends.